section right there, so we can hang out and ask questions and so on. There is a question section right on the top. So if you go right there, and actually I'm going to share my screen just to show you a second to make sure that you get it right. So there you go. All right, so let's put this bigger now. Sorry, I'm just trying to play around with all of this. Trying to get my, no, not the presentation, maybe. Okay, so sorry, it seems that I can't share my full screen on this display, so try and error here. Anyways, I'm pretty sure that you can see now the question section. There's 3 questions already. At the end of the webinar, I will stick around, answer all your questions, so please put them there. You will see them in the comments going, but I will not answer those throughout the presentation. I'll wait at the end. And for a first, I will be able to give you the presentation. So I am trying to give you the handout right now so you can download it. So hopefully it's going to work out well. I can see it's loading. So while it's loading, I am going to start with the presentation. You want to make sure that you have enough time to cover all topics. All right, so let's change this right here. There you go. Sorry, it seems that I'm running into a few technical problems here. I'm trying to get my presentation a little bit bigger, and it doesn't look right. We have to love those technical difficulties, right? All right, so I'm sorry about that. I will just move on with the presentation. I'm sorry it's a little bit small. Hopefully you're going to be able to download the presentation shortly. We have like several attendees that are loading right now, that are registering right now. So maybe this is what caused the problem with the platform. So I'll try to increase the size of my screen later on. Oh, there you go. So we got it now. All right, so we can move on. Today, we're talking about how to sell your losers. And I've chosen this picture mostly because, all right, so there you go. Sorry. Yeah, boy. Gotta love when those things are happening, right? Okay, so, well, you lost me, but at least you can see the presentation, so we're gonna move on. You're here. Sorry, guys. That's probably like one of the the worst start of webinars. Bear with me a second. The presentation will be loading shortly, hopefully. Wow. Okay, so I don't have the presentation anymore. Okay, so I have to load again my slides. It won't be long. Webinar. There we go. Okay, so I got my presentation now. Okay, so you can see that there's just a delay here, it seems. You can download the presentation now. It's in the handouts. It's obviously, okay, so perfect. I am here. The presentation is rolling, so let's get started. Sorry, guys, for all the troubles. There you go. Okay, so while you're here, today we are going to talk about how to sell your loser, how to identify which stocks to sell and which stock to keep, because obviously there's a lot of winners in your portfolio that you just need to be a little bit more patient, but it is important to make the difference between a loser that will hurt your portfolio and put your retirement plan in jeopardy, versus one that will eventually go back and it's just because the market didn't get it. Also, I'm going to share with you my tricks to make sure it doesn't happen again, that you have a loser in your portfolio, or at least not too many, actually. You're here also to ask your question. As I mentioned earlier, presentation is about 45, 50 minutes. And then you're going to have the question section right there on right besides the chat, where you can put all your questions. I'll stick around for a good hour to answer all of them and make sure you have a good time. You can ask me about stocks, about strategies, about the economy, pretty much whatever you want. However, I am not here to give you buy or sell recommendation. I am not your broker or your financial advisor. Please keep that in mind. I am not responsible if you're losing any money out of this webinar, and hopefully you're gonna make some. At the end of the presentation, I will invite you to join DSR. The presentation is not a sales pitch about my website, but we are using some tools and some tricks that are on there, and I will have a special offer for you. Now, why is it so hard to sell your loser? I think this is coming from the need and the expectation that we will perform, that we will make money out of our investment. I mean, this is the old point, right? You work very hard for your money, and then you put it aside, you do your due diligence, you're making your investment, you think it's a good stock, you think it's a good company that will thrive, and then stock goes down and you're left with this doubt of, should I sell? Should I keep it and wait? It's kind of like very difficult to know what's going to happen. Mostly, you don't want to end up buying high and selling low, right? Especially if you're a dividend growth investor like me, you have learned and you have been taught to be patient. And patient is one of like the key component for any successful investor. If you're not patient and you're just going after a quick win, you will eventually have a hard time managing your portfolio successfully. So you don't want that. And sometimes your ego will get in the way. So you think you've done your work well, you fell in love with the company, and you just think, you know what, the market doesn't get it. It's going to come back and it's going to feel good again. And I'm going to show you that I was right. What we have in mind when we do those things is companies like AbbVie. AbbVie over the past 5 years went down in the middle by 40%, and this is including the dividend. Basically, long story short, what happened with AbbVie, it's a pharmaceutical business. They have lots of patents for their drugs, not patents, but for the patents for their drugs, obviously. And they have one very popular drug called Humira. And basically, Humira is like half of the business. It's half of the revenue. It's even more in profit from what I can remember. And unfortunately, the patent arrived to expiry, and then other competitors will be able to sell similar drugs at a cheaper price. Sales are going to go down. Market was worried about that. Stock drops 40%. So then you're thinking, well, the company's still good. We're going to hold on to it. And actually, now it has gone back completely. So we're up 6% over those 4 years, including the dividend. So someone that has been very patient was just right. And actually now you have a stock that has momentum. They recently bought Allergan, which are the popular makers of Botox. They have pipelines of new drugs coming up to replace Humira sales that are very, very good, very interesting. The market is hype about it. New dividend growth, new dividend increase not too long ago as well. So everybody is like pretty much excited about the stock. However, many companies will end up like Peyto or Vermilion Energy. Those two companies got first hit in the 2016 oil bust. Stock price went down, difficulties, and then you're down like maybe 40, 50%, and you're thinking, yeah, but you know, we reach a plateau, it's not that bad, the company will bounce back, and you keep those hope up. Unfortunately, second market events happen in 2020. Dividend has been cut, and now you're losing 75, 85% of your investment. And this is the situation you want to avoid, because at this point, you have lost not only your capital, but also your source of income, because in both cases, dividend has been cut. So you're basically hit on both sides, and then you're stuck with something that will not likely ever going to bounce back. Now, one thing that is a little bit more, I would say, not that obvious, a little bit more pernicious actually, is to have losers that will be the wrong pick in the right sector. I've selected IBM for my example. Over the past 5 years, if you exclude the dividend, you have lost 3.6% on your investment, which is not the end of the world. You're going to tell me, and you're going to tell me, well, Mike, I'm still making that dividend on top of it. So I'm actually probably up by 13 or 15% by then. But the thing is, IBM has been one of the worst tech stock over the past 5 years. So while you would be happy with a 10% gain, including the dividend for the past 5 years, you've missed out on opportunities giving you 100, 200, 300, even 450% return with Apple. And the thing here is, I get it. 5 years ago, buying IBM was not necessarily a bad thing. And actually, you know, it's the big blue, strong brand recognition. It's been there for a while. The dividend is a lot more generous than a lot of other tech stocks, obviously. But after 2 or 3 years, you should have been able to realize that revenue growth is nothing. So basically, during that period, they had like one of the best milestone I've ever seen. IBM has posted like 22 or 23 consecutive quarter with revenue decline. So they have this narrative saying, oh, we're switching over to the cloud business and it's very exciting and so on. But the reality is their core business is slowing down so fast that they can't shift fast enough, and now they're lagging behind all the other peers. What I want to show you here is the opportunity cost that you're missing because you are holding onto your losers. So those are like the two factors that are super important when you look at like how and why you should sell your losers. The first one is potential to lose money, and the second one is missing out on opportunities. And one of the reasons why we keep those losers in our portfolio is what I call the break-even fairy tale. Basically, we just think, you know, the market goes crazy sometimes, our stock goes down by 10 or 20%, and we only need like 11 or 25% to break even. So when it's dropped by 20%, there's nothing to panic there. I have plenty of my own stocks that went down at one point or another by 20, 25%. And then just to break even, to recover from that loss, you need 25% increase. What makes it a little bit difficult is when you go over the 20% threshold. So the more you lose, the more exponentially the company has to bounce back. So you're losing 35%. The $10,000 that you invested is now $6,500. And unfortunately, now you're down to hope. It's literally hope that your stock is going to jump back by 54%. If it lost 50% of its investment, now you need the stock to double in price. So the question you have to ask yourself at this point is, what are the odds that this company will bounce back that much in the next 5 years or in the next 10 years? And am I willing to wait 10 years to see it happen? And I'm not too sure this would work, right? So why you should sell your losers? To avoid larger losses. If you're holding on to real losers, you will eventually lose even more than 40 or 50%, and you'll see your dividend cut. Waiting is a losing game in that category, and especially for opportunity cost. So while you're holding your money invested in those losers, that money is locked in. It cannot be moved or do anything. And then you have other opportunities on the market that you just have to let them slide and ignore. And those are crucial for your retirement plan. If you're having too many losers in your portfolio and you're holding on to them for too long, you put your entire retirement plan at risk. And this is why we need to find ways to sell the losers. So now that we have covered the why, we are going to cover the how to sell the losers and when to do it. And both answers are pretty much come together. So we're going to jump from how and when at the same time. But let's start by admitting that we were wrong. And I know it's tough because you have this impression that you've done your homework and that you've made a good choice by investing in this or that company. But if the stock is down 40, 50%, chances are there's a part of it where we have been wrong in our analysis, in our investment thesis, or in our process. And admitting the problem is, as pretty much everything in life, is the first step to discover the solution. And then at first, when this happens, I like to look at three factors. So I'm asking myself, what's the problem here? Is it because the market goes crazy? Like we had a great example back in March 2020, the market dropped like 35% within 2 weeks or something like that. And basically pretty much was a loser, like pretty any stocks were losers. And there was not much that we could do about it. And when you look at the market crumbling like this, there's no way it is a good time to make a trade. You just have to let it go. And this is where patience is key. But then it doesn't mean that you have to shut down your eyes and then forget about it and say, oh, it's the market, I don't want to hear about it. There's more to it. The second step is you have to go back and to look into the sector of the stock that is losing money. Now you have to look at how peers are doing. You remember my example with IBM. So IBM is going sideways, but all the others are like going through the roof. So maybe there's a problem not with the sector, but with the company. And that is super important. So what's wrong with the stock? And this is where you will put most of your time and most of your effort to understand what was wrong with that company. To do that, I have set like 3 simple rules for selling. The first one is to look at my investment thesis. The second one, if there's a dividend cut or an absence of dividend growth. And the third one is about portfolio management. So I like to keep things easy, clear, and straightforward for my investing strategy. And this is where and how I'm able to toss the doubts, toss the dilemmas, and focus on action. So let's start with the investment thesis. What you see here is my investment thesis coming from Dividend Stocks Rocks website about Alimentation Couche-Tard. I've highlighted that Couche-Tard is showing a perfect dividend triangle. This is one of my key set of metrics that I analyze. Like whenever I look and there's a problem with anything, I just look at the dividend triangle first. So the dividend triangle is 3 things: how revenue grow, how earnings grow, and how dividend grow. So in other words, when you have a company that is thriving, that has a strong competitive advantage, that they have like strong brand recognition, they're leaders in the market, they have strong market shares, technically their sales should grow. With growing sales, you hope that margin will continue to have the similar trajectory, so earnings will grow. And when you have a company that is selling more and making more profit, well, you expect that they will pay a stronger dividend. So this is pretty much the basis of my analysis. I look at the company. For Alimentation Couche-Tard, one thing that I love about this business is their ability to make acquisition and integrate them into their business model to make it more profitable. They have done so many acquisitions throughout the years. The management team in place has a huge expertise in those transactions, and they're not willing to pay a ridiculous price to just say, oh, we're growing. Great example that happened last year. Alimentation Couche-Tard was running after Caltex, which is a convenience store with gasoline sales in Australia. The deal didn't go through because management at Caltex wanted to have a bigger offer. Alimentation Couche-Tard was not ready to pay the price, and they said, you know what, we're not that hungry. We're going to let this one slide, and we're going to wait. Then they enter into a bidding war against 7-Eleven to buy Speedways. Speedway, then again, mostly in the US, great place, great market for Alimentation Couche-Tard. They know it because they own and operate Circle K. So they were very familiar with the market. They were willing to go ahead. And then the price goes up like there's no tomorrow. And they thought, you know what, it's not worth it. Let's leave it aside. Finally, they tried to buy Carrefour not too long ago at the beginning of the year. Carrefour, it's the third largest employer in France. grocery store. The market didn't like it. So the market was just like, they're going outside of their basket. They don't know nothing about groceries. They know about convenience stores. And now we don't like the stock. And the stock dropped by like 10% on the announcement. And when I saw that, I looked back in my investment thesis and I checked all the checkbox, and I said, well, you know what? There's no problem here. Let's move on. Let's keep Alimentation Couche-Tard. I actually even bought more of it just because it was a better price at this point. Now, absence of dividend growth or dividend cut is usually one of the most important reasons why I would sell a stock. I've picked Cominar, Chorus, and Masterich on this graph. Easy example to pick on, but what I want to show you, all companies have incurred huge capital loss for investors and also dividend cuts. But before they cut the dividend, you can see that the dividend growth was slowing down or going nowhere at one point. And this is a huge sign saying, you know what, maybe there's a problem with the business, especially if the business has this habit of increasing its dividend, even if it's like 2-3% a year, it doesn't matter. When you go down to zero, this is a problem. It's a problem because now management tells you, yeah, well, we are not too sure that we're going to keep up and increase our dividend because the business is going sideways, because we're facing challenges. We're not too sure about how it's going to end, and we're going to keep our money inside the business, which makes sense, but it still sends you the signal that there's a problem. I've become a little bit more lenient in 2020. I have kept my shares of Disney and CAE. Both suspended their dividend, but they had very good reason to do so, mostly because their business model was not aligned with a pandemic. It's hard to make money with people that goes into parks and take cruises and go to the movies when everything is closed. CAE, on the other hand, is a leader in the it's an international leader in flight simulators. You can expect a little bit less pilot that are going to take lesson or train to fly civilian airplanes, right? And then again, the company was thriving 5 years before the pandemic, and I expect them to go back and be very strong moving forward. So I have kept those instead. The third one, the third reason why I sell stocks is for portfolio management. What you see here is my asset allocation per sector for my pension fund. You can see that I am overweight in financial services, tech stocks, and consumer cyclicals. So most of the time, those are if I look at my portfolio right now, this is where I'm going to find my best performers. On the other side, I have like plenty of smaller sectors. And if there's a problem somewhere in my portfolio, I may want to sell a part of it. And then I'm going to look at my sectors to say, well, you know what? This company in this sector was not doing well. I'm going to sell it, but how it's going to affect my entire portfolio. I had to sell shares of Apple, not because it was a loser, but because it was a top performer in my portfolio earlier in 2020. The reason why? Well, Apple at one point reached 17% of my entire asset, my entire portfolio. Not only this one, but all my other portfolios. I was not willing to take that risk. I wanted to bring back the maximum weight of single stock to 10%. There's no rule there. It's pretty much just saying, you know, I prefer to have like a small exposure for one stock than having like something where if Apple tumbles by 30 or 40% in 2 years, my entire portfolio is going to get hit. So I want to protect myself against that and against such fluctuation. Now, when should you sell? Now that you have identified what is wrong with the stock, what is wrong with the sector, and what is wrong with the market, I don't think you should sell because you lose money, or you should keep it because you lose money. I think that the amount that you're losing, and it's true if you're making money actually on a stock, but the amount that you're losing is irrelevant. It sucks, it hurts, you feel bad, but it's irrelevant about what's going on in the market. You invested $20,000 in a stock, now it's worth $10,000. What really matters is, what are you going to do with that $10,000? Forget about the 20. 20 is gone. It's not necessarily coming back if you hold on to it. So instead of going this way, just focus on what you can do with your 10,000. And the best trigger you can have, and I love this quote from Peter Lynch, know what you own and know why you own it. If you know why, all the reason why you invested in the first place, you should know when to sell. There you go. First thing that you should do is to look at your investment thesis when a stock goes sideways. Look at all the reasons why you decided to buy this company. Are they still in place? What about their growth vectors, their market shares, their advantage, their metrics, their position in the market? Are those things are still around, or it's completely gone and there's a shift in the environment, there's a shift in the sector, and now you're stuck with losers in your portfolio that do not fit your investment thesis anymore. And at this point, you're better off selling than keeping those. Quick example there, a while back in like 2014, 2015 maybe, I bought shares of a company called Black Diamond. It's a Canadian company, and they are specialized in renting modular homes and modular offices to companies that have remote workers. The best example and where they have like grew their business and flourished their business was in northern Alberta, when a bunch of companies were going up north around Fort McMurray to explore and produce oil sands. Obviously, there was no infrastructure over there. There was missing cities actually to welcome those workers. So a company like Black Diamonds moved their modular home and modular offices over there, rent them to the company, and make a ton of money. You can imagine that it didn't go well in 2016 during the oil bust, and the company cut their dividend. And at that point, I decided to sell right away. I sold right away, following my rules. You know, the reason is simple. My investment thesis was Black Diamond is going to continue to enjoy strong growth from the oil sand. It will give them enough cash flow to eventually diversify their business and have not only Northern Alberta as main source of clients, but going elsewhere. That never happened. They cut their dividend. I sold my shares and I bought shares of Canadian National Railways, because you know what? Railroads, good or bad economy, you need them. They're not going anywhere. And at that time, it was a very good trade because they have been hit by the oil bust at the same time. So fear of a recession offered a great opportunity, and I just switched the money towards from Black Diamond towards what's its name? Towards CNR. I've been able to do that because CNR was on my potential replacement list. A great way to grow confidence and sell your loser is just not to look at the stock that's losing money and determine if you should keep it or not, but also having a list of stocks that you like, that you find interesting, that there are like growth vectors and dividend growth potential over there. And those companies, you may not be able to buy them now because you don't have more money to invest, or you're fully invested and you like your portfolio and your sector allocation, but still keep that list on the side. You never know when it will be useful. Because once you find one company that you really like and you don't have the money to buy it, the minute that you're going to have a loser, a process in your brain is going to change. Instead of telling you, Mike, you didn't do it, you were wrong, and you're losing money, and you're a bad investor, your brain is going to tell you, Mike, look at this opportunity. You can get rid of that loser and buy this amazing company instead. And this will facilitate your decision process. It will avoid some doubts and some paralysis by analysis, because you will be ready to make the trade already. Now, looking to my story about Black Diamond and Canadian National Railway, as you can see, At the moment that I've sold, the red line is Black Diamond. It goes up and down and eventually goes even lower. So potentially losing like 50% more than what I've already lost. Instead, I bought Canadian National Railway. And what you can see here, the stock is up 86% since I bought it. Obviously, it's total return. This includes a dividend, but it gives you an idea that, yes, I may have lost 40, 50% of my investment on Black Diamond, but I've recovered it over the past 5 years. And if I would have stayed with Black Diamond, I would be without any dividend at this point, and I would be losing even more money than I had before. And this is the lesson here, is holding on to your loser is going to make you lose even more money. Now, how could you make that list of potential replacement? Well, the first thing I like to do with my own portfolio is that I rate all my stocks. And you can use a pretty simple rating schedule. I used like from 1 to 5, and then I give a dividend safety score that you can see on the presentation from 1 to 5 as well. I don't want to get it too complicated. I don't want to calculate like dozens of metrics and having these weird formulas. Because you know what, in the end, if you cannot analyze your company thoroughly, and then you don't know about the business and you don't know the difference between the payout ratio and the cash payout ratio, for example, well, then you cannot depend on just metrics to make your decision. So keep it simple, give a rating on all your stocks, 1 to 5. So 1 should be a screaming sell, 5 should be like an exceptional buy. And then put a dividend safety score for all your dividend paying stocks. And after that, you can look at stocks in the same sector and you can use the dividend triangle, for example. So put out a filter showing only companies with growing revenue, growing earnings per share, and growing dividend for the past 5 years. So you look at those and then you're trying to rate them. And if you find a company that now is a 4 or a 5 on your list, and in your portfolio you have bad stocks, well, there you go. The shift will be easy to do. Here's an example of what we do at DSR. This is the part of my DSR Pro report. Every quarter, I receive all my stocks rating along with a summary of their latest earnings. So basically, I let the DSR team, we have like 4 analysts going through like 1,000 stocks, both on Canadian and US markets. They analyze the latest earnings and they give the pro rating and the dividend safety score. Now you have all your stocks that are rated, and the following page is the potential replacement list. So you don't have to do it by yourself. We provide you stocks that has strong ratings, so a total of 7 between both metrics. So you can see the first one is Activision Blizzard. It has a pro rating of 4, a dividend safety score of 4, so it makes 8. It is being put on the potential replacement list. So imagine that I have a bad stock in the communication sector, then I can easily look at this short list and say, oh, you know what? There are like a few companies there that could be interesting. I could sell my shares of Shaw Communication and buy Thesis instead, that has a stronger dividend triangle, great potential of growth. They recently spin off their TELUS International into TIXT, T-I-X-T, yesterday. So they're going to use the money probably to pay back a part of their debt, and they're going to continue to thrive among wireless segment, but also through agriculture and healthcare system. So this is how you can move from one place to another easily without having too much doubt, without like getting stuck in that paralysis by analysis. Now, how you can make sure it doesn't happen? Well, it gets easier if you are stricter and you are more demanding in regards to the stock that you're about to buy. Especially right now, because the market is quite complacent, and it gives you the feeling that you can buy pretty much anything on the market and it's going to boom and you're going to make money out of it. But it's not the truth. I've already discussed about the dividend triangle, but also when I look at a stock, once I have looked at those basic metrics, I will also look at other metrics and other factors. I will give the priority to dividend growth and not the yield. Why? Because a dividend payment is not magic. When a company is paying you $1 per share, its value drops by $1 per share. That's automatic because today you're giving a specific value to a stock, assuming that they have, I don't know, $200 million in their cash, in their bank account. If tomorrow morning that $200 million goes into your pockets as a dividend payment, well, obviously the company's value drops by that $200 million. It's not magical. So you're better off with a company that is able to grow their dividend payment year after year. So it shows confidence. It shows that the company has a robust financial balance sheet. It shows you that management is confident in the future, that they surely have growth vectors, that they will be able to thrive in the future. And those are the indicators you are looking for. Dividend safety first. As I mentioned earlier, you don't want to have companies that are slowing down their dividend growth or stopping their dividend growth. So just at one point, you're just like, yeah, we've been generous enough. We're not going to increase our dividend anymore for a few years. We're running into challenges or difficulties. This is a red flag right there. Super important. You have to be able to explain the business model of that company to a 12-year-old. If you're able to simplify how the business makes money, and you're able to explain it to anybody, this is the ultimate proof that you understand what you buy. So you know what you buy and you know why you buy it. And finally, it's always good to know what could go wrong. When I've discussed the energy sector earlier today with Peyto and Vermilion as examples, I obviously cherry picked my examples. Those are like very too bad investment. It's easy to look back and play Monday morning quarterback. But my message here is if you invest in the energy sector, you know that those companies are highly dependent on commodity prices. If the oil price goes down, your investment will follow. And if it goes back up, you will look like genius. If you are patient enough and you know the market enough and the sector enough, you could have made a lot of money in March and April buying new stocks at that point in the energy sector. But if you were holding them since the last oil bust back in 2016, you are just suffering. So it's important to understand what could go wrong and how it could go wrong so you can adjust your investment strategy and adjust how you invest going throughout time, throughout the market cycles. So what our process at DSR is different than others. First, I started investing in 2003, and I was what we can call almost a trader. I was trading like every 3-4 weeks, sometimes like every week to make money. So between 2003 and 2006, I leveraged a line of credit of $20,000, and I've made enough profit to put $50,000 in cash down on my first house. It went well. It was amazing. It was also the good years because everybody looks good on prom night, right? A monkey could have made good returns in 2003. Moving forward a few years later, I've grown up to have 3 kids. I've done my certified financial planner title, my MBA in financial services. I'm now a private banker in a big bank, working a lot of hours, and I didn't have that much time to focus like 3, 4, 5 hours on the stock market every single day to catch up those opportunities. And then I discovered dividend growth investing. That was in 2010. So between 2010 and 2012, I studied how dividend growth investing worked. I used my background in financial industry to apply more knowledge into it and to build my own process. I found out that dividend growers, on average, tends to outperform the market and do it with less volatility. If you look back at all the research, you'll see dividend growers, they do more money for you. They make more money for you with less stress. And I thought, you know what? I can find a strategy that will allow me to still have great success on the stock market, but I don't have to spend hours and hours and hours all the time on it, trading in and out. I can buy and hold and make less, making less mistakes, obviously, suffer less from losers because of that. And I designed DSR to be that tool that I use daily to invest. And DSR is all about having a clear, straightforward, and simple strategy. I think this is like the most important part. Regardless how you invest, keep it simple, keep it straightforward. It will reduce the amount of doubt that you will have. When you look at the overall market, you have to you may think, oh, it's overvalued and it's crazy, and I'm going to wait. I'm going to wait to see if it's going to go better later on. But the thing is, the market is always ahead of the economy. So right now, if your stock is losing 40% still, while the market has recovered, and you're just thinking, yeah, but I'm going to wait until economy is bouncing back, consumer confidence is going to go back, unemployment rate is going to be better. I'm going to wait until I see some inflation, and then I'm going to invest. Well, if you do that, you'll be super late because the market is already pricing this. A great example would be Disney. If you look at Disney right now, it looks like incredibly overpriced. Right now, it's like PE ratio over 90, forward PE ratio. Next year, they expect it will be trading at like 36 or 37 times their earnings. So there's no rationality in buying Disney right now. What the thing is, the market looks at how Disney has built its streaming platform. It looks at its expertise to use characters and ideas and movies to generate multiple streams of income. And now they're doing it through a streaming platform when everybody's at home and they're desperately looking to get more content, to consume more content, and to watch something interesting. They have like break all their expectations for their streaming services. Now they have 100 million paid subscribers, and the company expects to reach 250 million by 2024. The market is pricing this. They're not pricing the fact that chances are the parks will be open on and off and they will suffer this year for the coronavirus. They are pricing past that. And this is what is important to understand. Stock picks don't beat the market. A strong investment strategy does. We all make mistakes. We all lose money on our portfolio from time to time from a specific trade. Not too long ago in 2020, I had to get rid of my shares of Lassonde Industries. Lassonde is consumer staple. They're making juices and other products, consumer goods. Great brand name, super well established in Canada. They had growth vectors in the US because they were making acquisition over there. And I thought, oh, this is very interesting. They were increasing their dividend for like 10 years in a row. Great business, I love it. And it was adding a little bit more stability in my portfolio. I lost 40% on that trade. But at one point I was like, you know what? The stock is going down and I'm looking at the stock and I'm like, yeah, they're having problem integrating their acquisition in the US. They're facing more headwinds than expected in the US in terms of like costs are higher, transportation cost is higher as well. So margins are getting thinner. They cut their dividend. So all of this story that came out, and I thought, you know what? Let's look at my replacement list. And what did I found there? Well, I found VF Corporation, US company, brand management at its highest level. They bought Vans not a few years ago, and they made it an amazing brand. They run North Face as well. And what I've seen there is the stock price plummeted, obviously, because many stores were closed. But then what they did is they used their brand recognition to go online and improve direct-to-consumer sales. And in the meantime, in the process, they had the opportunity to make what they do best, which is making acquisition. They recently announced the acquisition of Supreme for $2 billion. So they made a great deal here to integrate another brand that is similar to Vans. So it's going to be a great partnership together. They have the expertise to develop that brand and make a lot of money out of it. And in a few years, I'm confident that VF Corporation will have me forget Lassonde Industries for a long time. But overall, I didn't mind losing 40% on my trades on Lassonde because all my other companies, they were doing well. My portfolio did well. In 2020, I was up more than 20% in my portfolio. Dividend growth was like almost 8%. So it was all good because I stick to my strategy. And I think that this is maybe like the most important thing, is not trying to jump on those like GME trade or BlackBerry trade or AMC that we have seen since the beginning of the year. Yes, it is tempting. Yes, some people made millions out of it. But if it's not part of your strategy, if it's not part of your investment process, there's no point in going there. How do my members do it at DSR? Well, you know what? They cut down the noise and they focus on a very narrow amount of choices. What we have built here is an amazing platform where it helps you to identify like the best of breeds for each sector. So your choices are easier to make, and we do the hard work. We do the analysis. We dig into understand why Enbridge payout ratio is like 300% and they're still increasing their dividend. We have those kind of answers for you. Is BCE dividend is safe? While you look at the payout ratio, it's over 100%. We have done the digging, we have done the work, and we can explain you why it's safe and why it has just increased their dividend today actually by 5%. So this is the work we do. We are developing this new platform that is coming up, and I'll try to see if the platform now is more stable to get it a little bit bigger. So now you can see my screen completely. We have a stock screener in the work. We are actually upgrading the platform next week. I'm super excited about it, but you will be able to create your own list, focus on the dividend triangle. We cover over 30 metrics, financial metrics. You can download them in a CSV file. You can filter them. So you can create all kinds of things with this stock screener that will be incredibly powerful. And for DSR Pro members, they will be able to create their own watch list. So, you know, the replacement list that I was talking about, and to build their portfolio online at the same time, get their all the tools that they will need to manage their portfolio right there. In the end, before I go into the Q&A, my message here: don't suffer from paralysis by analysis. You will always feel that the market is overvalued, that your losers will bounce back, that it's all going to end up well, and you're going to wait a little bit just to make sure everything is fine. Well, waiting is a losing game. If you wait on your loser, two things will happen. You will suffer from more losses and dividend cuts, or you're going to let slide amazing opportunities that will make your portfolio grow. More doubt leads to more analysis. More analysis leads to paralysis. Cut down the noise, keep it simple, focus on your strategy. And this is what we do at DSR. I'm going to try new things with this platform, unlock the offer. There you go. I can see it works. Good. So what I want to do here is to welcome you, to invite you to register to DSR. You have two options here. So the first one is a 45% lifetime discount to the platform, $97 per year. The platform will give you a few things. So you will have access to our portfolio analysis to make sure that you have the right asset allocation and to inspire yourself from what we do. You will have our stock cards analysis. So we have over 400 stocks, both Canadian and US, deep in analysis, easy to understand with our ratings. You will have weekly newsletter. Every Friday morning, you're going to get a newsletter. This Friday, actually tomorrow, it's the Mike's Buy list. So first Friday of the week, of the month, we issue our top 20 stocks. So 10 growth ideas, 10 retirement or income ideas, and both Canadian and US. So we cover everything there. Every Friday, every first Friday of the month, we change that list. And you're going to have also private webinars. So if you have enjoyed this webinar, you can skip the sales pitch next time and have more Q&A time with me. I'm staying around. I usually end up having like a 30-minute presentation and then an hour and a half with like amazing questions from my members. I've seen a few names in the comment section, like Rick, that is a member here, and they're doing an amazing job at supporting others and asking like smart questions so you can learn from them at the same time. So it's just amazing. Now, if you want to go pro, if you want to skip the hurdle of having to go through all quarterly earnings every single quarter for all your company and having the hard time of rating your stocks and then finding replacement, we do that for you at Pro. So DSR Pro will include everything that is offered at DSR plus the quarterly portfolio report. And now with the new platform that's coming in the next few weeks, you'll be able to build your own watch list, and you will be able to build your portfolio online with more tools to help you manage your portfolio. Most importantly, if you decide to go with us, we offer a 60-day money-back guarantee. I am not here to take your money if I cannot help you invest with more conviction. My goal, my role here at DSR is to make sure that you have all the tools to make the right trades, to not keep your losers, and take action. And this is what I do. And if I cannot help you, or DSR doesn't fit your strategy and you don't feel comfortable with it, you send us an email, and within 24 hours, you will receive a receipt of the full refund. No question asked. I'm definitely there to help you out. There's a question about the Pro columns on the screener. You will have the basically the question is the Pro columns on your screener reports is just for the Pro subscribers or the standard platform? It's offered on the standard platform. So all our stocks that have ratings, you will see them, and we will cover about 1,000 dividend stocks on the platform, and this is offered for everybody. This is not exclusive for DSR Pro. This is for everybody. I'm going to try again to share my screen a second. If it's not working, well, we are going to move away from that, but I'm going to, oh, there you go. So I can share my screen now. That's great. What I want to show you here is once you click on the offer, you will have two options. Obviously, you can read more information about how it works, how we help you rethink your portfolio, buy the right assets, and obviously retire stress-free. And you'll have more information about it. But what I want to show you here is if you're not ready to go with DSR, please don't leave empty-handed. Click on the free workbook and enter your email right here, and you will receive our portfolio workbook. It will help you. It's a great tool to build your portfolio, determine a great investment strategy, and help you invest with conviction. Completely free, 35 pages, lots of questions and exercises to make sure that you go through all the steps to build a solid portfolio. My members love it, and you don't need to be a member to use it, so that's great. And if you're interested in joining DSR, well, you click on, I want a discount, right? We all here for the discount. We offer the same subscription in Canadian and US dollars. So if you go right here, you have the Canadian options, and you can see how to enter your code. So when you enter the code right here, the price will change to $197. Actually, I'm going to do it right away right here. So I double click on the discount. I click on DSR Pro CAD. I put it there, and there you go. The price has changed to $197. The coupon code is good forever. This means that your price will never increase. Same thing, Canadian webinar for $97 a year for Canadian. And if you want to pay in US dollar, well, there you go. US subscription, same price, same thing. The reason why I offer it in the same price for both is actually quite simple. It's just that I'm Canadian, and I am upset when I have to pay in US dollars. So I thought at first when we created DSR back in 2013, we only had that option in US dollars, and now we have upgraded the platform and everything, and I had like more Canadians. So I thought, you know what, let's offer it in both currencies so you can pay in whatever currency you want. So now I'm going to move to the question section. I can see that I have already like a good 25, so it's going to be fun. There you go. All right, so Nilesh, what may be the reason for pharma stocks that are down, like Pfizer? The other one I'm not sure about, the astronauts and artists. So basically, a lot of the healthcare sector is down. It's actually kind of funny. A few weeks ago, I've done a presentation about sectors, and we have seen that we would have thought the healthcare sector would outperform the S&P 500 and during the pandemic, right? But it didn't happen at all. And actually, Pfizer was among the only one that did not too bad on this one. And one of the reasons I think is, you know, healthcare stocks are defensive companies. They're going to do their business regardless if there's a recession or not. You know, when you think about it, if you are sick, if you're not feeling well, you will be willing to pay for drugs or for medicines or for just to feel better. And right now the market is all about growth. There's this craziness of all the money that has been printed and injected in the market, and this is one of the reasons why the market is going so high and so fast. And now they're looking at pharmaceutical, especially big pharma, and they're just like, yeah, well, they have growth, but not that much if I compare to tech stocks, for example, or to GME. So for those reasons, they have kind of lagged and lost their interest. We have seen a similar thing with grocery stores, actually, for the second half of 2020. Exactly the same phenomenon. They started very high during the pandemic, during the crisis. Healthcare and grocery stores, they did well. And throughout summertime, there were just like not so much interest. And actually, it's a good thing. So it gives you great opportunities to invest in the healthcare sector right now, because the market is looking the other way around. So that could be very interesting for investor at this point. We have actually identified a few healthcare stocks in our buy list that is coming out tomorrow, because this is a sector that we think we have lots of opportunities. Okay, now Craig, looking at Canadian utilities, CU, should eventually turn, but when? Yeah, like this one in ADCO, they had a rough they had a rough time over the past 12 months. One of the major difference between those and the rest of utilities, right now the trend is towards renewable energy. And yes, they are moving their business model towards that, and they got rid of many of their coal activities already, but they are not thriving as others that are pure play in their renewable energy. So most of the market love is going to companies like Algonquin or Energex, Boralex, Brookfield Renewable, for example. And the other thing that is not playing in Canadian utilities' favor is its location. They have a lot of money. They are making a lot of money. Lots of revenues are coming from Alberta. Let's say that Alberta's economy may not thrive in the upcoming years. Now the oil market is getting better, so maybe there's going to be a shift, and maybe you can look for that to happen. And that could be interesting. Having said that, those are like the bear thesis. What I can see for both ADCO and Canadian utilities that I like is they have a very high yield. They have an amazing dividend growth history. They are the longest dividend growers in Canada. And they recently just increased their dividend, not by too much, but just enough to show you, you know what, we're still there and we're not facing challenges that are big enough to let us think that we should not increase their dividends. So for those reasons, if you're looking for more income, those could be very good investment at this point. Paul, I assume some of your investment are in a TFSA and that you buy and sell these investments. Are you concerned that Revenue Canada could consider this trading and tax the gain? Can you explain your guidelines a little bit? First thing first, as a dividend grower, a dividend growth investor, I am not like selling and buying stocks all the time. Last year was a very, very busy year, and I made, I think, like 2 sales and 2 buys. That's pretty much what I did, or like maximum 5 or 6 transactions, and that was a huge year. When I look at the past 2 years, in 2018 and 2019, I think I did 3 transactions throughout the entire time. So I'm not worried about trading activities in that sense. If you are going in and out with your TFSA and you're trading aggressively, right now, it's permitted. It is in a tax shelter account, as long as you don't take the money out of the account and you keep it there. So far, you should be okay. If you're more concerned than that, I would suggest you to discuss with a tax expert or an accountant. At this point, you know, trying to figure out how the government is going to tax us in the future, because there's a lot of rumors around will they tax the estate more, or what's going to happen with the TFSA or the RRSP rules, because they need to find money, right? We all know that. They have printed so much during the pandemic that at one point they will need to find sources of money. I am not worried about it so far right now. I don't think they're gonna destroy those accounts, mostly because they have been created for one reason, is to enable as many Canadians as possible to be responsible for their retirement. You know, if they kill your retirement plan, eventually what's going to happen is they're going to have a bunch of retirees that they will have to take care of. And that doesn't make sense for them. It's just having more people under their wings and to have to pay more, and it will be just like a huge never-ending hole of expenses. So I don't think they're going to kill our retirement account for that reason. Question from Jeff. What do you think of Zoetis, ZTS? If you like it, could it please create a stock card sometime? Actually, I have to look at it, Jeff. I think that you're a member, so thank you for your trust. I don't know much about Zoetis. It doesn't tell me anything, so I'm going to take a good note here, and I'm going to see what I can find, and if it's a dividend payer, and if it is, and if it fits our requirement, it will be in our stock cards. Kim, why company like Lightspeed had a bad financial report, but stocks increase, but AMD goes reverse? Oh, that's a good question. Can't really talk about Lightspeed because I'm not following this stock. It doesn't pay dividends, so I'm not really interested, but a lot of times it goes with the expectations and not necessarily the financial report by itself. You know, right now we are going through all the quarterly earnings with my team, and then we discuss, and it's kind of funny because you will have companies that are showing double-digit revenue decline and earnings drop, and the stock goes up by 4% because the market expected way worse. On the opposite side, you can have companies like BlackRock, for example. A couple of weeks ago, they declare amazing earnings. I think like revenue was jumped by like 18%. They announced a dividend increase. The company is like firing all cylinders, and the stock dropped on earnings day, because the market expected even more. Short-term fluctuations should not impact how you trade and how you invest. Especially, we discussed today how to sell your losers. Over a short period of time, I don't even look at market fluctuation because it's completely irrelevant. It goes up, it goes down for absolutely no reason. Sometimes it goes on. You know what? One day I wake up, I had Starbucks in my portfolio, and Starbucks is up like 7% on a day that has no news or whatsoever. So nothing expected from the business, from the company. And I thought, what's happening there? And funny enough, I go and I read that some financial analyst from a big firm just said, oh yeah, Starbucks is a buy. And there you go, the stock jumps. It was the same company the last day. So don't focus too much on that. Focus on the real reason. So if you know AMD and they're doing great and they have a great earnings season and they're moving forward alongside with your investment thesis, you keep your stock and then it's going well. And you know, AMD is in an ever-ending battle against Intel, and now Intel has shifted. They have a new CEO, and now they're back on track with their production for their new chip. And AMD has benefited from the fact that Intel was like, yeah, we're going to experience delays. It's going to be hard. We don't know what's going to happen. And then the second half of the year in 2020 was amazing for AMD and very bad for Intel. Now it has switched a bit because obviously they changed their CEO. They are back on track. They had a good earnings, and now a lot of the market is going back towards Intel. So sometimes it's just like, you know, small narrative that are like going around. Don't put too much attention to those. Focus on the long-term picture here. Jeremy, I use Wall Street Journals or WST, Wealthsimple. Yeah, Wealthsimple, I guess, as my primary brokerage. I use ETF for US economy stocks, but don't have any individual. Is it worth the conversion fees to peg them better off to different brokerage? Okay, so basically your question is, currently you have invested in US stock, in US ETF, and now you're wondering, should I move my money towards USD? and buy US stocks. Over a short-term period of time, the currency factor will play a huge role in your returns. Obviously, if you buy Microsoft today and you make 10% in profit by the end of the year, but the currency loses 15%, you're down 5% and it hurts. However, when you go through the next 20, 30, 40 years, the US dollar versus the Canadian dollar will not change that much. It's going to go up and down, but in the end, like your maximum exposure is like what, 20, 25%. So 20% over 2 years is huge, but 20% over the next 30 years when you can buy Microsoft, I mean, I guess you have your answer. Personally, I have invested half my money in US dollars and the other half in Canadian dollars. What I did is that I used Norbit's Gambit. I know a lot of you knows about it. Veronique, if you can put it in the comment section as an attachment. I don't know if we can do that this way. We usually are able to do it, but we'll see how it goes. Basically, you can search on the website on Google Norbit's Gambit. You're buying a US ETF, you change it to Canadian, and then you can move, or vice versa, and you can move money from one way or another. If you want to learn more about that, just send me an email just in case, and then I'll be able to send you the full strategy, but it's quite simple. Craig, my other loser is Chorus. Very nervous about that market, but they have crashed. Yeah, Chorus. When we analyzed this company at DSR a few years ago, we already rated it as a sell. The company was showing revenue decline. They were not showing any dividend growth. And we thought, you know what, you might sell it before it cut its dividend because it's going nowhere. Today, it's pretty much the same thing. You know, cable is not an industry that will thrive in the future. So unless they go streaming, I'm not too sure how they're going to be able to shift that around. They're still showing revenue decline. Advertising is going to be rough during a recession, and those personally would be part of losers that will not go back to their original value anyway. So you might want to think about what you can do with your money instead, and find other companies that look stronger today, and chances are they're gonna pay you off for the risk and the transaction. Stan, do you have an opinion on Two Harbor Investment REITs? I'm down 51%. Unfortunately, I don't know this one. Let me see here. Two Harbor. So that's a mortgage REIT. Mortgage REIT will have a few problems going down the way. Basically the thing is, mortgage REITs are making money out of the mortgages that they own, right? That totally makes sense. So they get their interest paid out of it, and now they're making money. When interest rate goes down, what happened is a lot of consumers will just refinance their property and will reach a better mortgage deal. So basically what's going to happen to the mortgage REIT is that they have this very generous mortgage paying like 8%, let's say, in interest. And now they're losing this one. It's being paid off and replaced by one that is, I don't know, generating like 5% of interest. So their margin is going to get squeezed, and it's going to be very hard for them going forward. And it's going to take a long time before we see high interest rate. I can't predict the future, but the way it goes, I mean, you know, most economists don't see the economy to recover fully until a few years. Airplanes should not reach their 2019 level until 2024. There's like so many uncertainties around the vaccine, and will we need another shot next year? Will it evolve and protect us to all the variables and so on, and different mutation of the coronavirus? All those things are unknown, and it's very difficult to know where the interest rate is going to go. At this point, I'm not seeing them increasing anytime soon, so it's going to continue to be very hard for a long time for this industry. Andrew, dump my BlackBerry in the Reddit army. When is a good point to buy BlackBerry? Back off. Is BlackBerry is a lost cause in the tech sector? Very interesting question. Long story short, what happened over the past few months? And Veronique, you can maybe put my video on the short squeeze in the comments, so you can go see on YouTube. I explain how the short squeeze happened. But long story short, BlackBerry is not necessarily going anywhere right now, and it's just a bunch of Redditors, let's call it that way because they're on Reddit, that decided to move some stocks up, especially companies that have a lot of short interest. So lots of hedge funds, they are saying, you know what, BlackBerry is going nowhere, GameStop is going bankrupt, and so on, and they short sell those stocks. By short selling, they make the bet that their stock price are going to go down. So if you convince enough people to move their money and to buy massively those companies, then you have something that goes up. And at one point, the short seller has to cover his position because they're short selling. They're selling an asset they don't even have. So one day or another, the broker calls and say, hey, I'd like you to cover your position. And to cover your position, since you short sold, you have to buy the stock. So now you're putting more pressure on the stock price, and it goes up even more. Add options into the mix, where options writer has to cover their position similar to a short seller. So at one point, when the price goes up, they also forced to buy more shares to cover the position. So everybody's buying, nobody's selling. There you go. It's a classic pump and dump. You're going to see what's going to happen with BlackBerry, AMC, and GameStop. Those are not good businesses, and they will eventually go down. And you know what? Especially because we're talking about the tech sector for BlackBerry, they are, I don't know, like a good dozen of amazing dividend grower in this sector. Why would you bother with BlackBerry when you can buy Sylogis or Texas or OpenText? And if you go on the US market, it's even wider, like Apple, Microsoft, Texas Instrument, Qualcomm, Cisco, Intel. There's like too many to let it go. So I don't see why you could think at one point that BlackBerry would outperform those big guys. Alan, sell Crescent Point Energy, Interpipeline, TransAlta. Those are big question. Obviously, I cannot tell you to buy or sell your stocks. Crescent Point, actually, what I'm going to do is I'm going to give you the ratings that we have for those companies. Actually, I'm going to show you how we do it. And now with the new stock screener, it's going to be even easier because it's going to be even larger and faster to get the information. But that's the current old stock screener that we have right now. But Crescent Point, do we have it here? No. So this one is already a sell. And then we had EPL, Interpipeline. So Interpipeline, pro rating is 3, dividend safety score 2. So you can hold on to this one. I think that now that they have cut their dividend, especially because they did it because they wanted to invest more money into their plastic factories. Moving forward, it's not a great stock, but it's not the end of the world. It's pretty much in the limbo right now. So if you want to get out of the energy sector, do it now. But if not, I mean, now the oil price is going back up. We can see that there's some strength behind it, so it could be interesting. And the last one was TransAlta. I can't write, sorry. TransAlta, pretty much same thing. The thing I don't like about those two is the dividend safety here. You have dividend safety score of 2 in both cases. I like dividend growers. If they don't grow their dividend, I always kind of like, there's something wrong with it. So for those reasons, I would probably move towards TC Energy and Enbridge, for example. P. Kelly, I am also interested in hearing your opinion on selling pipeline stocks, big downturn in prices. Well, there you go. TC Energy, I've done a video not too long ago, Veronique, there you go. You can put TC Energy and Enbridge video link. Those are 2 great pipelines. Yes, they're down in price, but when you look at the business and when you look how they manage their portfolio, their dividend is safe. They have huge capex, so they have like huge budgets. We're talking about 20 and 30 billions of investment. in the next coming years. What I like about TC Energy mostly is it's a play on natural gas pipelines, which are probably more popular than oil pipeline, for one. Second, most of their money is going towards developing this network even more. And the good thing about cheap natural gas is it gives a competitive advantage to industries and commerce here, because they pay cheap for their energy. They don't pay too much, and this enables them to be more competitive, which is amazing. So going forward, it's bad if you're a producer, but if you're a pipeline, you're just moving the money, the natural gas back and forth. So that's not a problem, and you can see the demand will increase from industries and from commercial use because it is cheap and they want to move forward with this thing. Now, Enbridge. Different beast, but the cancellation of Keystone XL, which was an oil pipeline that was supposed to be built by TC Energy, but Enbridge will actually enjoy the fact that there's not another pipeline. You know, pipelines, they work like railroads. You cannot have 10,000s of them. It's hard to replace them. And once they're set, well, they're there, and it's hard to move, right? So if there's not another route for the oil from Alberta, they will have to use Enbridge pipeline. So it's kind of like securing their long-term contract. One big difference between TC Energy and Enbridge, besides the fact that it's oil and natural gas, it's the average length of their contracts. TC Energy is more about 10 to 13 years, which is good, but it's not as good as Enbridge, which is more in more in the range, between 20 to 25 years. So it brings more stability, but in the end, both companies shows strong dividend growth, and they're not about to end that up. They have strong cash flow. And if you look at my previous webinars, I have done one on the payout ratio, and I explain how to calculate the one for Enbridge and TC Energy, and both of them shows very healthy payout ratios based on distributable income, so you don't have to worry about those. Fed Chairman Ben, what is the best argument for holding dividend stocks versus high performance stocks like Google, Apple, and Amazon? Actually, you can have a mix of both. I do have Apple because it is a dividend stocks, paying stocks. The thing is, it's very easy to analyze and to track when a company pays its dividend. I am not a dividend investor in the sense that I'm looking for a yield and I think, oh, whenever a company is paying me 4%, I buy it and I'm good with that. I don't buy this strategy. What I buy is looking at dividend growth throughout time, those trends, because they will tell me where the company is going, how management is confident about the business, and if the company is generating lots of cash flow and they have a robust robust balance sheet. So it will be my ultimate indicators to pick those companies. And actually, it's kind of funny because a lot of people think, well, dividend investing is for like income-seeking investors, retirees. It's not going too good. It's just like pretty much like boring stuff. Well, as long as I trade my portfolio, my active trading portfolio to dividend growth investing, I've publicly report my returns since 2012. I consistently beat the market. In 2017, I quit my job officially from being a private banker at National Bank. I received my pension plan fund. I invested over $100,000 between September of 2017 and December 2017 using DSR tools to build my portfolio. And my portfolio averaged 19% since inception. So for the past 3 years and a half, 19% is a lot more than the US or the Canadian market combined together. And they're all dividend payers. So it's not true that you have to sacrifice growth in the name of dividend. You can find both, and it is being found among dividend growers. But mind you, I do have Amazon shares though, because Amazon is like my favorite my favorite non-dividend paying stock. Alan, opinion on AGF, also a big loser for me. I am not a big fan of pure mutual fund businesses. That includes AGF, that includes CI funds, and that includes IGM, IG Financial. in Canada. Why? Because the trend is not there. The trend is not in mutual funds that you have to pay like 2%, 2.5% fees. We're going towards robo-advisor. We're going towards Wealthsimple with $0 trade, or like Quest Trade, and even like the bank account, their bank system charge now like $10 a trade and stuff like that. So you have ETF, you have robo-advisors, you have low discount brokerage. I don't think the future is there. So if they don't pivot, they're gonna miss the boat, and for that reason, I don't see how they're gonna grow in the future, how they're gonna thrive in the future, and those are the reason why I don't like them at all. Final one. That's all right, Alan. I'm here to answer your questions. What about ARC Resources? Well, unfortunately, this one I haven't looked at for a long time. I bet it's in the energy sector, so you pretty know what I think about it right so far. Sorry about the rest, but yeah, I'm not a fan of the energy sector because they don't make good dividend growers, as I explained today in the presentation. Marouche, what are your thoughts about Laurentian Bank? They have cut their dividend. Laurentian Bank was on our sell list, like screaming sell, like 3 years ago. 2018, 2019, 2020. I don't like them. Actually, it's not even, sorry, but I don't like Laurentian Bank at all. I'm pretty sure that Véronique is smiling right now. Hey, by the way, I was like so focused on that new platform. I'm sorry, I didn't even introduce Véronique. Véro, that is in the comments. Hey, Véronique. She's my core business manager. She's helping me with the webinar. She's part of our team. She's been there for 10 years with us. Okay, perfect. Thanks, Véro. Yeah, sometimes I don't read the comments, so that's a good thing she's there. But anyway, she knows that I consider Laurentian Bank as a convenience store, basically, or a lemonade stand. Smallest bank pretty much in Canada, or almost, have to compete in Quebec with the 5 big banks, but also with Desjardins and National Bank. They have not the size and the scale to match those banks. They have no strategy whatsoever. I've been in the banking industry between 2003 and 2016, where I decided to take a pause of 1 year. I went on an RV trip all the way down to Costa Rica, and when I came back, I decided to work on DSR. But for my entire time there, like the weakest player, the player that was the easiest to win against was Laurentian Bank, because they have no structure, they have no support behind them, and they have a hard time figuring out what they want to do, and it's going to continue going forward. So I don't see this one doing better than the big 6, because I always include National Bank, not because I worked there, but because it was the best performing banks for the past probably like 15 years now. So they have not made the right decision and the right strategy. So unless they can prove me wrong and make a major shift, this is like one of the rare bank I consider selling. And it has been rated very poorly since 2018 at DSR, way before they cut their dividend. So if banks are all not growing their dividend due to government, yes. Mind you, I don't think they would have increase it anyway. I hope that you're not suggesting to sell them. Well, actually, they're not big losers either. What do you think will happen when government allow dividend increase for banks, extra dividend, regular increase? If you look back 2008 financial crisis, similar thing happened. They paused their dividend their dividend growth for a few years. Actually, I love Canadian banks. My favorite are Royal Bank and National Bank. Strong third would be TD. After that, not too kind of Scotiabank and CIBC. What is interesting about banks is they have this oligopoly here that they are well comfortable making money, and now they found other growth vector. TD is doing it in the US and through wealth management. National Bank is doing it internationally now through also capital management, capital markets, and wealth management. And Royal Bank has half of their revenue coming from different sources besides classic banking activities such as savings and loans. So they do insurance, wealth management, capital markets, and a little bit of US as well. So they're pretty much all over the place. I think that once they will be allowed to increase their dividend, they might wait another year. I don't think they're going to be in a hurry. If you look at what happened in 2008, I think the first bank to increase their dividend, it was National Bank, and it happened in 2010 or 2011. And then BMO was the last one, I think late 2011 or 2012. This is a similar scenario that I expect, but in the meantime, the dividend is super safe, and they have showed how they can manage their loan portfolio, and now they are strong banks throughout the pandemic. Obviously, there's a delay between not being in a good place in terms of finance when you're a consumer and having a hard time paying your bill and declaring bankruptcy. So I think that there's a lag over there that we're going to feel a little bit more in 2021 and maybe in 2022. But I don't think it's enough to break the banking system. Far from it. So they're well capitalized. We have one of the strongest system in the banking system in the world. I'm not too worried about those. And actually, National Bank right now is on the top of our buy list, among the top of our buy list at DSR. So it gives you an idea. What is my opinion on Interactive Corp EAC? Interactive EAC, let me see that. That's why I don't know anything about it, because unfortunately it doesn't pay dividends. So I have not looked at this one. Flew right under my radar. So sorry about that. Ash, when you mention buy list, it's weekly or it's in your newsletter as part of the DSR subscription? It is once a month. The goal here is not to overload you with information and to buy and sell and to tempt you to make trades. Every first Friday of the month, the DSR newsletter is about our buy list. The buy list is a list of stocks that we like at DSR, but for one reason or another, the market doesn't like it too much, or we think that there's a timely opportunity there. Here's a good example, Alimentation Couche-Tard. The company has been having a hard time. That's down like double digit for the past 6 months, yet they are recording amazing results. They are on track to double their earnings between 2019 and 2023. They are on a growth path. PE ratios at 13%, at 13. So it is on our buy list. The goal of that buy list is basically just to let you know, it's like, okay, Ash, you have losers in your portfolio. You're looking for ideas. You can look at our DSR portfolio, but obviously in our portfolio, if we bought BlackRock at $400 5 years ago, and now it's trading at 750, you may not be tempted to buy it right away, and we get it. So this is why we're just like, hey, you know what? Maybe you don't want to buy BlackRock right now because it looks overpriced to you. We still think it's a good company and we would buy it today. But let's look at another company that is trading at a lower level at this point. And we're going to offer you those every month. But the buy list, we keep track of them. We keep track of our choice from 1 month to another to make sure that we provide some value. And over time, I can say that we have roughly like, last year, I think it was like 18 or 19 stocks out of 21 that beat the market. We just closed 2 positions on Apogee Enterprises and Intel, way above the market. We have selected CAE in October last year as our #1 pick. You can guess it went up by 50% the time it was there. So it's not a sure shot all the time. We do make mistakes as any others, but it gives you good ideas of like which could be interesting right now on the market. Next question. Sorry. Looks like NFI Group is down today after they announced bought deal financing for $250 million. How do you weight this new information? You know, like Bailey information for me is just market noise. Does it change the fact that NFI Group is the largest bus manufacturer in North America? No, it doesn't. Does it make a change in the fact that they generate like 70% of their revenue coming from contract with cities that are like rock solid? Because you know what, people will need buses to and transportation across cities. It's not going to end tomorrow morning, so there you go, it will be there. And they are taking a greener term by optimizing their buses fleet and so on. And all of this, yes, they're getting like financing deal. And I haven't read this news today, but for me, this is just short-term fluctuation. And if you look at how NFI is going up and down over the past year or so, or even more than that, pretty much any good news or bad news is going to impact the stock by 3-4% in a single day. I would not take too much time to look at this, because honestly, that's noise. Over the long run, you won't even remember why the stock lost 4% today because they got that $250 million deal. It's completely irrelevant for the long term. It will become relevant if you're following the stocks every quarter, and every quarter they're getting more debts and more debts because they're having a problem and they can't make enough money and they're not profitable. Then you have a problem. But that is by following the stock every single quarter with their earnings, and then you will see the full narrative being developed around the stock, and you'll understand if it's worth it or not to keep it. There you go. Steve, hi Mike. When you convert your RRSP to a RIF, how do you manage the dwindling dividend and the tax increase based on the withdrawals and the extra taxable income? Very good question, Steve. So to explain that question is, in Canada, when you have your retirement account and you turn 71, the government is a smart guy. You know, your retirement account is tax shelter and they want you to pay some taxes at one point. So at 71, your RRSP is being transformed into a RIF, which is basically the same RRSP account, but now you are forced to withdraw a specific percentage of your account every single year, and that is linked towards your age. So the more you age, the more you have to withdraw. And at one point you reach like close to 90 and you have to withdraw like 20% of your account every single year. So basically they want to force you to pay some taxes on it. So first, how do you manage that? First, you have to manage the amount that you must withdraw. So when you're retired, what we discussed at DSR, a good plan should be you retire and then you have between 12 to 24 months of your retirement budget in cash. And then you let the dividend being accumulated there. So it gives you even more than 2 years worth of income before you have to sell shares. It helps you to see the market, how it goes, and determine when it's the right time to sell. Obviously, it was not the right time to sell in March. You could just withdraw money from your cash account up to a point that you're just like, oh, the market is going back. I'm going to sell a few shares, rebalance my portfolio, and make sure that I have always enough cash. In terms of tax optimization, that really depends case by case, depending on your entire situation. I'm not very good at giving tax advice at this point, because your accountant or a tax expert will be in a better position to tell you, okay, so you have this kind of income, you have that kind of income, and now you have the RIF. We have to manage all of this together. As a financial planner, we were planning this a way at time, make sure that everything was optimized. At this point, a little bit hard for me to tell you like where you should go, but a certified financial planner will give you some insight, and then an accountant or tax expert will complete the wheel. Jim, thoughts on TRP and bridge? Well, I got it already, so there you go. You got my answer earlier today. Option on WellPoint, opinion on WellPoint. I don't know WellPoint, sorry. So this one, I cannot tell you anything about this one. Question about Cineplex, slowly creeping back. Is it the old or replace? That hurts because it brings me bad memories. I have not invested in Cineplex, but a few years ago, it was in some of our DSR portfolio models. We kind of liked the fact that they were transforming their business toward other recreational activities. They have like 90% of the market share in movie theaters in Canada. So they were well established. They looked nice, and they were able to pay their dividend even though it was very high. So it was all good, and it was in our portfolio. When the purchase agreement happened and they were supposed to be bought out, we actually sold our position at this time because the stock was going down all the time. The market didn't buy that people will continue to go to movie theaters long the run. And today I am pretty much sure that it's not going to happen. It's going to take forever for movie theaters to open, and it's going to be complicated, and a lot of like a major step that happened with Disney and now HBO Max, which is owned by AT&T. A major play was before those movie theaters, AMC in the US was saying the same thing. If you ever dare putting your new movie on another platform, a streaming platform or elsewhere than in our movie theaters at first, we're going to shut you down and you will never be able to put another movie in our rooms. Now they don't have that strength, and Disney decided, hey, you know what? Let's put out Soul and let's put out Mulan on the streaming platform. HBO Max did the same thing with Wonder Woman, and they're just like, hey, you know what, AMC, I don't care about you anymore. You're closed. You have no power over me. So now that movies are being released at the same time on different platforms, I really don't know how Cineplex is going to be able to thrive and succeed in the future. Will the stock bounce back momentarily? Maybe, maybe not. But honestly, I would not invest money in those because this is like a speculative play. It's a fun play, but it's not part of a long-term investment strategy. And yeah, that's pretty much it. All right. Now, Richard. Sorry, I just have a little issue here. Okay, now there you go. Richard, do you have other factors in your service which are specific or geared toward being who are retired today, as we are more reliant in year of dividend income? Yes, we do. First, dividend safety score. It would have protected you from major dividend cut in 2020 and 2018 at the same time. Most companies, like in 2018, it seems very far away now that we have in the pandemic, but it was like just 3 years ago. 2018 market crash, bear market for 6 months. Lots of companies cut their dividend. Most of those dividend cuts were prevented with a dividend safety score at DSR. Same thing happened in 2020, so you can rely on that. We have retirement portfolio, and I would say my average member is like, the average age is probably around 50, 55. So they're either retired or about to retire shortly. And I have a lot of clients, a lot of members that are retirees, 60, 65, 70 years old, and they rely on dividend income to build their portfolio. And what is important for them at that point is stability and make sure that they receive their income. And we like by being very picky in our methodology, we are able to satisfy both those who wants to grow and those who wants to have something stable. Our buy list is 50% growth idea, 50% retirement idea. We have retirement portfolio for both Canadian and American. And during our webinars, we discuss several retirees topic at the same time. So yes, we cover it from like one place to all the way the other. And I think it's very important. I was a financial planner for 10 years, 5 years as a regular financial planner, and then I got a promotion as a private banker, so dealing with only millionaire as clients. And the struggle is always the same. One day you stop working, you stop the ability of generating money, and now you're getting concerned about fluctuation in your portfolio, and you want to make sure that you don't outlive your portfolio. So I'm very well aware of those risks and how to manage them as an investor. So yes. Would you please explain why you must be accredited investor to buy shares in a private placement? Is the company trying to hide something? Why they do not go public? This is a little bit more complicated, but basically it's all about regulations and processes. When a company is public, everybody can buy shares, but when it's a private company, yes, you have to be accredited investor because there's less. It's not because the company is shady or anything. It's not because they're hiding something. You know, like by definition, all public companies was once a private one. Airbnb was private until late 2020, and before that, you could not invest because you need to be able to understand how the financial statement works and the potential loss as well. So it's more to protect retail investor, and also the fact that you must invest a large amount of money to be considered as an investor. Obviously, at the beginning of Airbnb, if you go there and just like, hey, I would like to buy like for $10,000 of shares, they need to raise millions, almost billions of dollars. You know, Robinhood had to raise like $3 billion in the span of the last 6-7 days. So they cannot do it with like $10,000s or $50,000 per investor. So this is one of the reasons. Monica, does DSR have stocks for people with limited investing funds, sometimes for people with 10K to invest? Yes, we actually have portfolio models starting at, we call it the 25K portfolio, but it has 10 positions. So basically the way it is built, and actually I'm going to share my screen for you to show you that, because right now I know that this technology works, so that's really cool. So now we're back on the website, and let's look at our portfolio models right here. And this is a page that you can go and you can look at our portfolio here. And what do you see here? If you click, you won't be able to get access to anything there, but you can see our returns. And we do have 25, 100 and 500K portfolio. The difference between the three is that we have 10 position and then 20 position and then 30 position. So this is the difference. And then we have a 100% Canadian portfolio, because the other Canadian portfolio are half US, half Canadian. This one is 100% Canadian stocks. And then we have retirement portfolios. What you can see here, just for fun, the total return, those were created in 2018, right before the market crashes. So perfect timing to invest, right? Right before bear market. Total return for retirement Canadian is 26%. The benchmark was 11. So we benchmark against XDV and VIG, two dividend-paying ETFs, and retirement 40% versus 36%. So on top of being stable, we actually outperformed the market, which was not even the purpose. So it gives you an idea. So yes, we do cover a smaller amount. With $10,000, you can easily start with a 25K. You have 10 position, 1,000 per position, and as you grow, you can use the buy list, and then you can use a rating to improve and add more stocks to your portfolio until you grow to 20, 30 stocks. Personally, I don't think that going over 30 stocks is a good thing. I do have like 32 or 33 position in my own portfolio, and I'm spending my entire day watching the market and writing newsletter and studying stocks, right? This is my job now. So basically DSR is paying me to manage my portfolio, and I don't even want to exceed 40 stocks in my portfolio. So it gives you an idea. George, Crescent Point, a big loser, will ever recover for moderate comeback, or the oil energy? You know what? The way you ask me that question, it relies on hope. You hope that the oil price is going to bounce back. You hope that Crescent Point will be able to serve the next oil wave. Hope is a bad investing strategy. If you're not able to find something within the business that makes it a leader and that makes it a company better than all the other peers in the energy sector, you have your answer. Maybe it's going to bounce back, but maybe not. You know, you can, like, trading on hope is not going to help you out do anything. And this is why it's important to say, like, first, go back and say, why did I wanted to buy the stocks in the first place? What were the reason? And if you're just saying, oh, because the energy sector is going well and now there's money to be made there, well, then you have your answer. And you, unfortunately, you learned the hard way. It's very hard to make money on the energy sector unless you buy low and sell high, but you do not keep running the wave. It's very hard at that point. Bill, what do you think of Walgreen? It's way up now, headed down. I haven't followed Walgreen too much recently, to be honest. For a long time, it was part of our favorite healthcare consumer staple stocks at DSR, but unfortunately the company hasn't been able to convince us that they can manage the entry of Amazon, and they're having always a hard time to generate more growth across their drugstores. At this point, it is rated as an old like a 3, so like pretty much like an okay stock. I think it's an okay stock because it's going to go through the next recession without any problem and stuff like that. But I don't see it as a growth company. So for that reason, I would probably not necessarily invest in this one. What about preferred shares? Preferred shares are interesting because they give you higher yield, but they're less liquid, and you will not be able to participate in the growth value of the stock. So for those reasons, I prefer to invest in the stock. If you look at preferred versus regular stocks for banks, for example, I might want to surf on the stock growth instead of going preferred and then having like 1-2% more in terms of yield, but being stuck with it. It's not a bad investment if you're looking for income and you don't care about the growth. Then preferred shares, especially if you look at like banks or telecoms, could be quite interesting. Now, Bob, my strategy has been to move into CEF, so closed-end funds. While not exclusively CEF, individual company stocks are now the exception when I buy. I am dividend growth investor. I reinvest my dividend automatically. My question are these. Would DSR be of use for me since I concentrate on CEF and ETF? Unfortunately not. We don't cover those. We really focus on stocks, and I'm going to tell you why. Every time I look at an ETF or a CEF and I look at their top position, their top 10 holdings, I always identify 1 or 2 or 3 companies that I don't like and I would not invest in. And this is why I prefer to pick my own stocks. Then your second question, would my reinvestment of dividend strategy be held by using DSR? Well, as long as you're looking for this dividend stocks, yes, we'll be able to help you out with this. But on the other side, don't expect any information on CEF or ETF, and we're not moving towards that direction at all. This is not something that we want. Dan, Silogist, SIZV, please tell us why you like it. First, it's subscription-based model. So basically, they have like plenty of government and public entity contracts. Those type of clients are not likely to move their business on one way or another. They're pretty stable. Subscription-based means recurring revenue, which we like. The company has no debt. That is another good thing. And when you right now, if you look at the earnings and the payout ratio, they're out of the blue and they look crazy. And that's because they changed the management compensation a year ago. And there was a one-time payment that killed the cash flow, killed the earnings for that year. And now they're trailing that. In a few months, it should disappear from the past year, and then everything will go back to normal. The company has no debts, and they has like plenty of money that they're generating. They have increased their dividend twice last year. I mean, that's crazy. Obviously, it's trading on the TSX Venture, small cap, so expect more fluctuation. Sometimes it flies under the radar and the market doesn't see it, so it doesn't get as much attention as open text, for example, or Texas. But still, for the reason of no debts, especially right now, no debts, recurring revenue, tech stocks, stable client, those are the reason, and amazing dividend growth history over the past 9 years now. Those are the reason why I buy it. You're asking, yeah, the reason why Silogist trades with little volume will affect the stock price, obviously. So you have to expect more volatility, and sometimes the stock will go dormant because there's no news or no activities for a while. So you have to be a bit more patient. What are your thoughts on GWell? GWell is Jameson Wellness. It has dropped a little bit lately. Yes, it does. Actually, it's kind of like victim of its own success. The market was expecting, I don't know, ridiculous numbers because right now they're double-digit growing, double-digit revenue growth, double-digit EPS growth. And from what I remember, if I remember correctly, I think the dividend is following the same trend. Actually, we like, I'm just going to take a look here. We like Jameson Wellness at DSR. You know, they are selling vitamins and supplements. So being like building your immune system, being healthier, taking care of your body has been trending a lot. It's even better. It's a bigger trend now that we have the pandemic. So for those reasons, it's a very good company. And oh yeah, there you go. I'm going to show you that. I'm going to share my screen here. I'm going to show you. So now I've pulled out the stock cards for Jameson. So you have all the information right there. So you see pro rating of 4, dividend safety score of 4. So basically we really like the stock, but what we like is look at this dividend triangle. I'm going to try to put it a bit bigger for you guys. So there you go. So what do you see here? Yeah, you see that the price has dropped, but what we see here is revenue is on a steady increasing trend. Earnings per share is growing as well, and the dividend is look like marvel. So this is a very strong dividend triangle. You can see the numbers. Oh, you don't have the 5 years here because it hasn't grown that much, but it is prone on a good start right there. And I think that they will continue to sell a lot, and they're growing internationally as well. Their Asia segment is growing fast, so I think it's a great time to buy. Actually, it is on our buy list right now. You'll get more information on GWell tomorrow if you subscribe to the DSR because it's part of our buy list tomorrow. Ian, my evaluation of Leon Furniture. Leon Furniture looks good on prom day. That's what I think. The company has now no debts or barely no debt because they have paid off their acquisition of Brick. They look good, and they have surf on that weird tailwind in 2020 where everybody was locked down at home and they thought, dude, I need a new bed or I need a new kitchen table or whatever. So they went and they shopped like crazy. They did home renovation. They bought a cottage or something like that. And now they bought a plenty furniture, and Leon has surfed on that tailwind. However, if you look before the pandemic, Leon was not growing their revenue that much. And this is something that bugs me a lot. If the company is not able to grow during economic boom, because between 2015 and 2020, before the pandemic, the economy in Canada was thriving. And now they're just like, yeah, the company's like revenue growth are minimal. They're nothing. And this is, yeah, now they're good, but it's more related to the pandemic. So I'm a bit concerned about that. Kim, you're asking, does DSR portfolio doesn't need to hold bonds in the portfolio? We are all 100% equity focus investment services. However, in our 500K portfolio, we have included roughly a 30% portion of bond ETF. Pretty much just to give you an idea of what you can do to like mix both. I can see that in their DSR Pro report, a lot of our DSR members, they use a 35% of their portfolio to invest in bonds or other kind of ETF, and then they use the rest to invest in dividend growth stocks. So you're going to get a few ideas, but we're not going to discuss bonds individually, and we're not going to discuss those ETF. It's just like portfolio models. For me, this part is easier because you just have to buy a few bond or ladder bond ETFs, and then you're set for that fixed income part. So we rather focus on dividend growth. And you know, you have companies like you know, Canadian Utilities and ADCO earlier that we discussed today, BCE, Bell, AT&T on the US side, Stag Industrial. They're all companies that are not going to grow that much going forward, but they're paying like a 5-6% yield, very stable. So we look at them and we call them deluxe bond. So basically companies that you should not expect much in terms of capital growth, but you will have great value in terms of dividend and very good stables. Is the stock screener going to be part of the regular membership? Yes, it will. You will have access to the screener. What you will not have access to is the ability to build your own list and the ability to build your portfolio from that, from the screener. But access to the screener, the ratings, the stock cards analysis, that is for everybody. Janet, in your portfolio, you list the sector of ETF. Would it be broad market ETF? Actually, that's part of the legend. But if you look, if you would have stayed longer on that screen, it has 0 in ETF. It's just that because we have several members that has ETFs in their portfolio, BSR Pro will not review your ETF, but they will put them together and show you the value of how much I've invested in ETF for your portfolio. So this is why you will have it there. And in the new platform, when you build your portfolio, if you have ETF for a specific sector, you will even be able to put that in terms of sector. So instead of being shown as ETF, if you buy like a tech ETF, for example, it will be added to your tech sector. So it will be a little bit more tailored. But I don't have any ETFs in my portfolio. Mike, thank you for your help. Well, you're welcome. What are your thoughts on AltaGas? I bought it high, was able to average down, but it has been a dog. Dividend safety as well. AltaGas at first, big disappointment when they cut their dividend. It was kind of like, it came in a surprise back in, was like, what, 2018. Right now, from what I can remember, it has a rating of 3. It's an old. Let me see here if I can pull out the rating for a dividend safety. I'm not too sure if it's a 2 or a 3. AltaGas, it is still a 2, so definitely not a huge winner there. Then again, my favorite stocks in this sector, in the sector of utilities, you have like so many other companies like Emera, Fortis, Algonquin, Brookfield Infrastructure, Brookfield Renewables that are amazing, that I would not necessarily lose my time with this one. Fern, where do you park cash for someone who is not 100% in equities? That's a very good question. I would invest it right away. You know, like waiting. I mean, you can, if you park cash because you're waiting to invest, you're never going to get the right time. So put yourself in a timeline. Let's say divide your amount in the next 10 months and invest 1/10 every month, or put it for the next quarter or for the next 6 months, but start investing. If you're just waiting to see, oh, it's going to be a good timing now, it's never going to happen. It's never going to be a sure shot. The market will never tell you it's a good thing. You know what? It's kind of funny because when you think about all the other years in the past, you have a very good reason not to invest every single year of the decade between 2010 and 2020. You had the Brexit, you had the Greece going bankrupt, the Eurozone collapsing, the trade war with China, one oil bust. You have so many good reasons to not invest, and yet it was one of the best decade that we have seen as investor. So not wait. If you want to park your cash, if not, high interest rate account that pays you like 1%, it's not much. So I rather buy like safer dividend stocks and be very picky in your approach, so you can have like solid businesses that will not collapse in your end. Will, what about senior living? Sienna Senior Living. You have it at DSR as a favorite, and you concern a lawsuit from COVID. That's a good question, actually. If we have it in our favorite, yeah, you're right. Maybe a time that we have to look at it again. What we have liked about this one is that so far they have managed the COVID as good as they could. They haven't cut their dividends, so it's a good thing. And in that sector, those are very rare stocks that were able to hold on to the fort. Going forward, it's going to be very difficult, and it's already priced in the market, considering the fact that now they have to pay more expenses to take care of their resident, and on top of that, they will have less residents. So less revenue, higher expenses, maybe not the place where I would put more money into it. I'm going to look at this one It's probably due for an update or something like that. Not too sure. It should be still a favorite on this one. Thank you for bringing it to my attention. Zaporov, TFI International bought UPS. I guess you want to know what I think of it. I think, well, UPS has a rating of buy on our side. It has been an amazing business. They grow through acquisition. They know what they're doing, and they're sticking to their business model in terms of commercial transport. In 2020 they have went with an IPO on the US market to get more cash, and I think to make those kind of businesses, the market loved that transaction, and I'm pretty sure that they're going towards the right direction. Monica, what is the ticker for TC Energy on the TSX? It's TRP. TRP. So that's the ticker. So maybe you see it as maybe preferred share or something like that. Rick, you're mentioning that Enbridge is a pretty nice retiree stock. You're right. Yield is over 7%, very solid, not at all at risk. So there you go. Thank you for your input on this one. Is HD Home Depot is a good buy now? Well, obviously the easy money has been made in the home renovation industry. Lowe's and Home Depot did very well last year. Right now, I mean, I love the company. I love its network. They've been amazing dividend grower. They are like getting market shares away from Lowe's. They have a great, what I like also is that they can compete with Amazon easily because most of their stuff is like heavy, so it's hard to deliver and so on. So I think they're going to do well in the future. If you don't have such company in your portfolio, it's not necessarily like the best timing ever, but it's not a bad timing either. So you might want to consider it. Guys, I can see that I still have 20 questions, but it's been an hour where I'm answering questions. I know that the webinar is about to close, so I don't want to go forever. I am sorry I could not answer all your questions. I've done my best. I did like 47 answers, so I hope that it's going to be enough for you guys. I'm going to look at the others, hopefully be able to answer them in a future webinar. I tend to do like once every month or something like that. So thank you for your time. Thank you for being there. Look at the offer. Also, I need to tell you, as we are moving to the new platform with more tools, this kind of promotion, the $97 a year, the $197 a year, are about to disappear forever. We're still going to run a few webinars like this, but then prices are going to go up pretty much in a month or so. So you're going to have like one last time to get it at this price, but after that it's over. And those that have locked those subscription at a lower price, we keep improving the platform, but you keep your price forever. I mean, I think Rick has been with us for the past like 4 or 5 years now, so you can guess that he has an amazing deal, and his price has never increased, and your price will never increase. But I can tell you that the new guys that are coming in April and May, they will have to pay a lot more to access DSR. We are building something that will help you invest with more conviction, retire stress-free, and be at the right place at the right time, and not have to doubt and suffer from paralysis by analysis. So then again, thank you so much, Richard, Monica, Kim. You've been amazing. You have so many people here. I'm sorry, again, I could not answer all the questions. I know that we have lost like 5 minutes with tech problem at the beginning, but at least the platform seems to be running well at the end. So thank you so much. See you next time, and look forward for my next webinar. Cheers. Bye-bye, guys.